Now to Egypt, where fintech company valU has officially listed on the Egyptian Stock Exchange, a major milestone in one of the region's fastest growing sectors. Joining us now is Walid Hassouna, CEO at valU, to talk about what this listing means for the company, the fintech space in Egypt, and what's next in their growth journey. First of all, how long have you been working towards this? And then why did you ultimately decide to list valU on the stock exchange?
Yes, so we have been ready actually for an IPO since 2024, in March 2024. The decision was taken in the end of 2022, and we were preparing documentation, structure, and everything that helps us to go for an IPO. As you know, IPO requires a lot of transparency and a lot of governance. And as a startup, we needed around a year to be ready. Unfortunately, 2024 was a very difficult year to IPO. The market was not very good here in Egypt because we decided we're going to IPO in our home market. And the market was not very good due to FX issues and very high inflation rates, also massive increase in the lending rates that we were receiving from the banks because of the increase of the policy rate. By the end of 2024, we had excellent results, and we decided that in November 2024, we decided we want to go public, and we're ready to go public. And we were lucky enough that the Financial Regulatory Authority in Egypt and also the stock exchange were very happy with the structure that we submitted for them. It was not a real IPO where we raised money, it was more listing in the stock exchange. And the reason behind that we didn't need to raise any money at the point. The company was self-sufficient, so dilution was not an option for us. But we had a major, and we still have a major shareholder, which is EFG Holding, that at the time owned 87% of the company. The rest was distributed between us as management and some of the VCs that were part of one of the acquisitions we have did in 2022, a company called Paynas. EFG decided to distribute its dividends for this year in the form of value stock, and they decided to do this at book value. So this was around 1.5 cents of a dividend distribution, and our current market cap would give those guys a huge upside of around 10.5 cents. So it just raised 10 times, increased 10 times. We are IPOing because we think this is a very good exit for our shareholders. Now they have an open market where they can sell the product and they can sell the shares, which I think the most important thing. Also, it helps us in case we want to raise money in the future to have direct access to public markets. Especially Egypt is known for a lot of institutional investments, as you know, in its public market. So the reason behind that was also to be able to raise capital easier to fuel our market expansion, especially in Jordan.
Awesome. So now you've mentioned that you did not necessarily need to raise money at the time you listed on the exchange, but this was also a partial listing. Can you share why you did not do a full listing and chose to go with a partial listing instead?
In Egypt, it's very important for the main shareholders to have a lockup period because it protects small investors. So no one would go into a full listing because this will mean that the main shareholders will be able to sell 100% of their holding. And this happens only a year after based on the Egyptian law. So partial listing is the way that every company in Egypt could start an IPO with, and then followed 1 year after every single share becomes unlocked, and accordingly you reach a full listing.
Okay, awesome. I know this has just been a month since you listed, but what has the response from the market been like?
Actually, the market responded very well. We had an excellent roadshow in the UAE and in London, and also virtual roadshow with investors in the US. Luckily enough, now we have around 20,000 shareholders in valU, which put it as one of the biggest shareholder base in Egypt right now. Since we launched, we have not fallen below the fair value, which is equivalent to around $350 million. and the company has also a lot of liquidity on its stock. So the stock has been very liquid. And good news, last week we got approved and admitted to marginal lending index in Egypt, which means people can borrow money on our shares and can do marginal borrowing on our shares. So since then we have seen a very solid market for our shares, and we have seen a lot of volume being traded and exchanging hands in the market.
Awesome. So just zooming away from value right now and looking at the broader African ecosystem, why do you think we've seen very few listings in Africa from tech startups, whether partial, just like you've done, or full listings?
I think there are multiple reasons. The first reason is the stock exchange markets in Africa are not as big as the others in the GCC or Europe or the US, of course. So this definitely puts a lot of pressure on listed companies, because with listing you need to have liquidity, and if you're not going to have a liquid share, then you have a problem on that for sure. This is one thing. Second thing is the way startups has raised money in the past was always done through VCs, and basically VCs would like to see more of M&A transactions where they have a full exit and not a partial exit as what happens in the stock exchange. Also, it puts a lot of pressure on VCs because they will have to market the value of their shares based on the change in price on daily basis, while if they do multiple rounds, then definitely they can market based on the most recent round. So I think it's two things: a macro level on how liquid the market is in Africa and when it comes to stock exchanges, and the other thing which I think it's important, that VCs would prefer to have a full exit via an M&A transaction to be able to post their returns. But to be honest, Egypt has witnessed a lot of exits for fintech companies, and the most known one would be, other than value, would be Fawry. Fawry was able to do an exit through stock exchange a couple of years ago, and most of the PEs and VCs were able to exit with 10x of returns. So Egypt remains to be the flagship for exits for fintech through the Egyptian Stock Exchange.
Awesome. So just what do you think can be done to encourage more startups? I know we've talked about the macro, which makes it a bit difficult because that's not really something you can control as a startup. But what can we do to encourage more startups across Africa to list publicly?
Yes, I think the first thing, they have to be ready for listing. So they have to have excellent governance. And as you know, unfortunately, when you are a startup, it's very difficult to apply the governance benchmark. So one thing they have to work on is to make sure that they have excellent governance. Second thing is transparency. And I think most of the African startups, they lack transparency when it comes to the rounds they raise. You never know what was the valuation. Of course, there are few exceptions to that, but most of the startups will not declare what valuation and what structure they raised money through. So the second thing is transparency. And the third thing, which comes with a lot of cost, that they need to have also a functioning investment relation department. And finally, they have to have access to asset managers, because basically once you become listed, you start having a very different class of investors, not your normal VC PE structure, but mostly asset managers that mostly invest in across the world, not in a certain sector or in a certain country or a continent.
So just to what extent do you think that startups on the continent seeing events like your listing, to what extent do you think that listing like this can help to solve the exit challenges that we have across Africa?
I think this is the best way to exit in Africa now, given what's happening in the market and what's happening in Africa specifically. The best way to exit or to partially exit is to be ready for a listing. Listing will help a lot of investors to have access to data that they normally don't have access to, and it might actually grab the attention of big players or strategic players to fully acquire those companies, because now they have real access to data, they have earning releases, they are sure about the quality of earnings and other things.